Okay, hello everyone. Welcome to our new video. We will talk about the second chapter, which is about financial markets and institutions. And first, let's start with talking about different types of markets that constitute the whole financial system. In a financial system, we have various types of markets that investors trade, buy and sell different assets. There are physical asset markets versus financial asset markets. In a physical asset market, you would trade the physical asset. For example, you might trade the physical gold, right? That's the physical asset market. Or you might be trading some physical commodities, such as rice, coffee beans, etc., some other products. On the other hand, we also have financial asset markets, and there are many different types of financial assets, including bonds or stocks, etc. So these are some examples of financial assets. And then we also have spot markets versus futures markets. And in the spot markets, that means we can purchase something immediately, versus in the futures markets. In the futures market, basically you are getting in an agreement to purchase or to sell a given underlying asset at a future date. So the futures markets is a bit more complex in the sense that we are not exchanging anything right now, but we are one side is agreeing to buy, the other side is agreeing to sell from the agreement price. That's also called as the futures price. So the structure of a spot market is different from the futures markets. As you see, in the futures markets, we are actually making an agreement only, but there is no actual exchange of that good or of that commodity. And actually, we will talk about more details of futures markets. We can define a futures product with respect to the underlying asset, such as a bond. Underlying product can be the bond, so we can agree on the future price of a bond, or we can trade commodity futures. In commodity futures, the underlying asset is a commodity. It can be, for example, precious metals, gold, silver, or agricultural commodities, or industrial commodities such as copper, aluminum, etc. In all these products, basically the concept, the working of the futures market is the same, where two sides agree. One side has a long position, the other side will have a short position. Basically, that means one side is willing to buy, and the other side is willing to sell from this agreement price. That's the mechanism of futures market. We will discuss these in more detail as we progress, but at the moment we should try to understand what's the difference between the spot market versus the futures market. And the spot market is the immediate exchange. I can go to the spot market for gold. I can buy, let's say, 1 ounce of gold, and exchange, I pay the money and I receive the gold immediately, right? That's a spot transaction. But in a futures transaction, if I want to take a long position in a gold futures contract, then I am agreeing to buy the gold at a future date. So it's not immediate delivery. And then we have money markets versus capital markets. Again, that's an important separation in financial markets. Money markets, we deal with short-term assets which has maturity less than 1 year, whereas in the capital markets we will see that there are products that are assets with longer than 1 year maturity. So it can be the long-term, for example, mortgage loan, these or other long-term bonds, government bonds. There are 10-year, for example, treasury bonds. These are traded in the capital markets. Or there is, of course, the stocks that we can also trade. That's also part of the capital markets. Okay, for example, here you can mention the stocks. Or bonds can be another example, but here we mean the long-term bonds, because for the capital markets we require that the maturity should be longer than a year at least. And then there is so-called separation between primary markets versus secondary markets. In the primary market, again, the details we will discuss later on. But in the primary market, basically we are talking about the initial offering of an asset. For example, the government can issue a bond, basically the treasury, for the first time. So that's part of the primary market for the treasury bond. Or there might be the initial public offering, the IPO, of a stock. Again, that's going to be the primary market that this transaction takes place for the first time. Whereas in the secondary market, that means once this asset is issued, it will be traded afterwards in the secondary market. Okay? If the secondary market doesn't exist, then the primary market is also probably not, it will not exist either, because investors are willing to purchase an asset from the primary market because later on they can sell this asset in the secondary market. For example, if there is no stock exchange, you wouldn't maybe be willing to purchase or join in the IPO of a company because you won't be able to sell your stock if you need cash, right? That would be very important. The secondary market is very important in order to have a well-functioning primary market as well. So these two, complement each other. And also there is private markets versus public markets. Again, the markets can be separated in terms of whether it is private or public. Some markets are set up by the government, or in some cases they are set up by private corporations as well. So now giving a bit more again definitions in these different types of markets. Basically the spot markets, the definition is given here. The markets in which assets are bought or sold for on-the-spot delivery. So here the key is when we say spot market, we are talking about on the spot. At the same time we pay the money and then we receive and we got the delivery of that asset. So that's the important feature of the spot markets. For the futures markets, the markets in which participants agree today to buy or sell an asset at a future date. So this future date, we call this term maturity, okay? Or you can also call this as the expiration date. Okay, so there are different terms we can utilize here, but the most common term you will see is the maturity of a futures or an option contract, for example. So there should be a predefined maturity date, the date that we will actually make this physical or cash settlement of the contract. But in the first instance, basically two sides, the buyer and the seller, just agree on the price and on the condition that at some future date, at the maturity date, the delivery will take place. So that's the futures markets. As we said, there is the money markets and capital markets. We can also separate the financial markets in these two categories, depending on whether the asset is a short-term asset or long-term asset. If we have less than 1 year maturity in our asset, then this will be called as the money market asset. It will be part of the money market product. For if you have a long-term debt like mortgage-based securities, or there are long-term government bonds or the stocks, all these are examples of products within the capital markets. And as I just explained, the primary markets versus secondary markets, the definitions are again given here. The primary markets, in which corporations raise capital by issuing new securities. Raising the capital can be in the form of issuing debt, issuing the bonds by the company, or the corporation can issue shares. That's the initial public offering in the stock. For example, in the stock markets, you might have the IPOs, and these new stocks they start to be traded in the stock market after the primary market is completed. So the secondary markets, markets in which securities and other financial assets are traded among investors after they are already issued. So once the primary market stage and initial public offering is completed, then the secondary markets start to trade the specific asset. For example, after the IPO is completed, the stock is starting to trade in the stock market. Okay, the IPO stage is actually it's not necessarily taking place in the stock market. The underwriting companies or investment banks, they collect the demand for the IPO, and once IPO is completed, then it will start to trade in the stock market. As we said, private markets in which transactions are worked out directly between two parties, and public markets are standardized contracts that are traded on an organized exchange. So in the public market, basically everything is taking place publicly, like stock exchange. Stock exchange can be privately owned, or it can be owned by the government. Both is possible, but still it is a public market in the sense that it is open to everyone, right? Such as the stock exchange, it is open to the whole public and all the investors to invest in these stocks. Whereas in the private markets, basically we are talking about the over-the-counter markets, especially where transactions take place between two institutions, or for example, the special product is designed for a corporation, and investment banks are quite active in these private markets. They design special financial products for their customers, and the customer can purchase these by the private market. So recent trends, let's talk a little bit about the recent trends in financial markets. As we all know, globalization has changed a lot of things, and a lot of financial centers are interconnected to each other, and especially the stock markets, bond markets, affecting each other. And the globalization has exposed the need for greater cooperation among regulators. So there is a need or there is a demand for standardizing the regulations across borders. But that's not something that can be immediately achieved, because each country has its own financial problems that they use various policies and regulations. So it's difficult to expect all the countries apply the same financial regulations and rules. That would be a bit difficult to achieve. And there are factors that complicate coordination, which includes the different structures in nations, banking and securities industries, the trend toward financial services conglomerates, which obscures developments in various market segments. So this means there are also large conglomerates. In other words, we have a very few corporations controlling most of the financial services industry. As we know from economics theory, for a well-functioning market, for an efficient market, we need competition. We need many entrepreneurs, and we need many companies that coexist and compete to give the best service and best price for the customers. However, in reality, we are observing there is a bigger concentration of capital, and only few corporations exist in the financial industry, and this is causing a lot of debate and problems to provide the customers better quality service and better lower prices for this service as well. There is also the reluctance of individual countries to give up control over their national monetary policies. This is another important aspect, because individual countries now, they don't want to give up control over their monetary policies, because politically, each country, the government, the political system is trying to get higher votes, and they will be willing to use monetary policies or fiscal policies to achieve this. However, in order to basically have the same financial services industry or similar quality or free flow of the funds, then financial industry expects more standardization and uniformity across the borders. So they expect the free flow of capital freely, but as we know, many developing countries such as China, India, South Korea, or even there is time to time debate about the Japanese currency. So the currency, whether is promoting the export industries of the local country or not, is a big debate. So time to time, countries such as China, they might prefer their currency to be undervalued compared to US dollar or euro, in order to give an advantage to its exporting industries. This is just an example. But in essentially, countries and governments, they want to have more control over their monetary policy, because they can promote, for example, export oriented growth, and they want to increase their GDP growth further. Therefore, this monetary policy can be a tool in this regard. We will see more details of, again, monetary policy and its effects, but these are recent trends, and these discussions actually are being made, are put forward in many countries as well. Another important trend has been the use of the financial derivatives. We will also talk about the financial derivatives and various types of products in this category. And a financial derivative, first of all, is a security whose value is derived from the price of some other underlying asset. For example, an option to buy IBM stock is a financial derivative. In an option, what we have is the right to buy a specific asset at the maturity date that is given on this contract. Let me summarize again. For example, if I am holding an IBM stock option, I will have the right to buy this IBM stock from a specific price that is written on the contract. And there should be a maturity date written on the contract as well. For example, if the maturity date today for an option is January 2024, I can exercise this right to purchase the IBM stock until this date. So I cannot exceed the maturity date. Okay, that's the example for an option. But we actually, in the recent years, there has been many different types of financial derivatives that are used in the financial markets. Another phenomenon that we have observed in 2008 financial crisis, actually there has been a rapid expansion in the use of financial derivatives until this 2008 financial crisis. So as you remember, in 2008, we had this financial crisis that started in the US market, right? It started in USA. It started actually with declining house prices and the mortgage markets, like subprime mortgage loans and the securities that are derived from these loans created big problems. And after this 2008 financial crisis, actually the use of derivatives, or the expansion, let's say, the expansion of the financial derivative industry has stopped, okay, at least for some time. It slowed down. It lost its previous growth rates as an industry. But still, of course, financial derivatives such as option markets are quite important, and traders can utilize these markets and financial derivatives to not only to speculate, but they can use this for hedging and risk management purposes. Basically, a financial derivative, as we said, the value of this derivative is derived from another asset, and we call this other asset as the underlying asset. Okay, for example, as we just mentioned, the IBM option, if you go in the US market and purchase an IBM call option, that means the underlying asset is the IBM stock, and you have the right to purchase this stock, IBM stock, until the maturity date. This is an example. And here we have various financial instruments and the market that this instrument is traded, some major participants, and the riskiness of the product is explained. For example, corporate bonds. These are traded in the capital markets. Usually, as you can guess, they have longer than 1 year maturity. And these are issued by corporations, held by individuals and institutional investors. What about the risk of such product, corporate bonds? In the Turkish markets, we also have corporate bonds such as like Arçelik and some other corporations issue also bonds. But these are, of course, considered to be riskier than the government securities in any given country. They are going to be more riskier. They will be riskier than, for example, Turkish government bonds. The bonds of the Turkish corporations will be more risky. Similarly, in the US market, the US corporate bonds will also be more risky than the US government's securities, because the governments always have the authority to borrow more money by printing, increasing the money supply. They can actually easily finance their obligations, or they can just raise the taxes, right? If they need to pay their debt, they can collect more taxes from individuals or corporations. So they have the authority of lawmaking. Therefore, these or they actually making the law is not the same as the government's actions, because in each country the legal system might have some difference. But essentially, we consider the government securities as less risky compared to the corporate bonds. There are many other types of instruments, such as common stocks. Again, these are issued by corporations, and individuals and institutional investors purchase the stocks, common stocks, and they are also considered to be riskier than the bonds, because, here the bonds, we mean both government bonds and the bond of the same corporation. Okay, so if the same, for example, Arçelik, they issue the bond, but they also have the common stocks. So the common stock of the same company is riskier than the bond, corporate bond. Okay, because the bondholders, if the company defaults, the bondholders have the priority to get their money first. Okay, so they are in a less risky position compared to the shareholders of the company. So this is an important detail. But also there's preferred stocks issued again by the corporations. Again, the individuals or institutional investors hold these stocks, and again, these are generally riskier than corporate bonds, but this is just a bit less risky compared to the common stocks, because the preferred stocks also have the privilege over the common stocks. Okay, so that gives some advantage over the common stocks in terms of the riskiness. Okay, let's finish this part, and then in the next video we will continue with the second part.